Welcome everybody today, and thank you for joining us for our presentation on a COVID-19 relief update. I know everybody has COVID fatigue these days, but we wanted to give you another update. Not everybody has finished up their PPP forgiveness or their ERTC credit request, so just want to make sure everybody is doing that. I'm Carolyn Powell, Business Development Director here at Tronconi, Segarra & Associates. I'll be your host today. As many of you know, there's multiple ways you can engage with us. There's a toolbar to the right on your computer screen. You'll find a copy of today's presentation and full bios of our experts, so I don't think they need any introductions. You've all heard from them. There's a chat box if you want to send a general comment today. And then the question box for any questions that you have for our experts. We'll save those until the end and get them answered then for you. And then after the presentation, you will receive a webinar survey. If you'd like to complete that survey, let us know what you thought of the presentation, give us some feedback. If you would like to talk with one of our experts after the webinar, let us know. And also let us know if there's any other topics you want to hear about. So without further ado, let's get started. Tronconi, Segarra & Associates is a certified public accounting and business consulting firm. Tom Mazurek is a CPA and partner on our tax and SALT team and has over 23 years of experience. Chuck Pezzino is a CPA and partner on our accounting and audit team and has over 25 years of experience. Together and their COVID team have helped over 300 companies with their COVID relief and various programs. Again, their bios are in the handout section of the toolbar. So I'm going to pass it over to Tom to get us started today.
Thanks, Carolyn. Good afternoon, everybody. It's good to be back with you guys on a webinar talking COVID, which this was all gone away by now, but we still have some things to wrap up. It's been Chuck, like over 6 months, I think, since we've done a webinar together on this, but just have some updates for you today. You can see here on the agenda slide, just gonna go over some highlights on, these major programs that were big in the last 2 years, from the federal government, from PPP to EIDL to the Employee Retention Credit, and then some of the other programs that may not have received as much attention or were kind of specialized by industry. Just want to give you an update on where things stand, what you should be doing these days, and talk a little bit about the federal and state income tax implications of these programs as well. So we'll get into it here on the next slide with PPP. The Paycheck Protection Program, long been closed since 2021, early 2021 with the second draw loans. Right now, the big thing is forgiveness. As you can see on this slide from SBA, there was about 11.4 million PPP loans issued in 2020 and 21, first or second draw loans. There's about 1.9 million loans still out there that have not been forgiven. So if you break that down on some of these other statistics, about 12% of those loans, or 228,000, are from 2020. If you haven't gotten your 2020 loan forgiveness application in, you're probably paying your bank back now plus interest on that loan amount. Really, need to get that in there and get that off your books. And then the balance of those loans, about 1.7 million are from 21. And, we're seeing right now, we're working with a number of our clients, helping them with forgiveness, and people have questions, but definitely want to get this, taken care of, this quarter, if you can, get it off your books, and move on to other things. So on the next slide, just talking about loan forgiveness. If you haven't done forgiveness yet, just a reminder here of what costs are eligible for loan forgiveness. The big one, obviously, are payroll costs, which include your wages paid to employees, healthcare plan expenses, retirement contributions, and state unemployment tax payments. Now, payroll costs have to be 60% of your forgiveness. You can spend the other 40% of it on these other non-payroll expenses listed here, from mortgage interest payments to rent to utilities to certain operation expenditures, supplier costs and whatnot. And, for most people, really, doing the payroll should be sufficient for you. But, as Chuck will talk about in a few slides, the employee retention tax credit, if you are eligible for that in 2020, well, now 2021, really you need to look closely at what you're using for forgiveness so as not to kind of hurt yourself in your ability to maximize the employee retention credit as well. And Chuck will get into that a little bit more. On the next slide here, just some notes on PPP. I think everyone knows at this point that PPP loans are not taxable. There's a repayment obligation, obviously, when it's received. But unlike other normal loans, when they're discharged, they're generally taxable. The CARES Act back in 2020 made it so that the PPP loan forgiveness would not be taxable. It's excluded from your gross income. And your PPP loan forgiveness is actually excluded from some other calculations like your PERTC gross receipts and whatnot. So it's very important. If you remember initially back in 2020, the IRS said that those expenses that give rise to your loan forgiveness are not tax deductible. That was a big issue in 2020. The Consolidated Appropriations Act that was issued at the end of 2020 corrected that, saying that yes, you can deduct those expenses. One note here, and this is very limited, if you did file for forgiveness on a 2020 loan before these changes were made, let's say you had a fiscal year tax return in 2020 and you filed your return and you deducted those expenses, you did not include those expenses that you paid with PPP funds on your tax return, the federal government did say that you can go back and include those expenses on your 2021 return using a safe harbor. Right here, RevProc 2021-20 kind of goes into more details on that. Very limited number of people that applies to, but if that was your case, you definitely want to make sure you're including those expense deductions on 21. The next slide here, just talking a bit about the PPP loan being recorded on the balance sheet, and the portion that's forgiven is written off to the income statement as tax-exempt income. Obviously, it's not taxable income for tax purposes, but will increase your book income on your income statement. And then there's also some additional guidance that recently just came out at the end of 2021 for S Corps, providing that your PPP tax-free income and the expenses giving rise to forgiveness should be included in your OAA, your other adjustments account, not the acute AAA, as a lot of people thought. And for Schedule C businesses, you just report your deductions as usual, and there's no forgiveness to take into account there. The last thing we really want to talk about with PPP from a tax point of view is these RevProcs that the IRS issued in late November of 2021, really just kind of talking about forgiveness and how it applies in certain situations. I think the most important one here for generally for most businesses is this 2148. Really just provides guidance on the appropriate timing for a borrower to take that tax-exempt income into account. You can either do it when your eligible expenses for forgiveness are paid or incurred, an application for loan forgiveness has been filed, or loan forgiveness has been granted. And even Chuck, I guess, regarding loan forgiveness these days, that timing we've seen go down, right? I think on a lot of what the applications we're doing, we're seeing the SBA turn these around pretty quickly.
Yeah, it seems like the lenders are able to turn around the application in a matter of weeks in most cases, not all, but in most. And then it goes to the SBA for approval. And I wouldn't call it a rubber stamp, but it's definitely not taking very long. So all in, we're seeing 2 to 3 weeks from application to notification of full forgiveness from the SBA.
Yeah, I think especially for those, different types of forgiveness, there's 3 different forms, I guess, out there. The 3508S for the simplified loans under 150,000. Those you really don't have to provide any detail with it. those are getting approved very quickly. And then the easy loans, that you can use the easy calculation if you were suspended or you didn't make any adjustments to your FTEs or your wages and salaries. Those are moving along really quickly. I think, the only thing that's really an issue these days is when you're using the 3508, the main application, and you might have some FTE headcount adjustments. But I think what we're seeing is that there's more than enough payroll and other expenses that help you overcome any adjustment you might have to make if you, laid some people off and they didn't come back, or your business doesn't allow them to come back. Because there were exceptions, right, Chuck, if you couldn't hire people back.
Yeah, if you, if it was the employee's decision not to return to work, essentially, that wasn't counted against you as a negative FTE because you did your best to either bring that person back or hire someone else in the position, and the fact that you weren't able to do it as a business wasn't held against you.
Yeah, so I think they're making it pretty easy for everyone these days. And if you refer back to that first slide that kind of shows the calculations and the number of loans being forgiven, I think I calculated it's like 98.5% of loans that have applied for forgiveness have been forgiven. So you're talking minor amount of loans that have had some amount not forgiven out there, but it's moving along really well. So on the next slide, the next RevProc, I'm really not going to get into it. Really, it just kind of provides guidance on how partnerships may allocate deductions and tax-exempt income in connection with the forgiveness of their loan. Really, it's a matter for the partner's interest in the partnership, how you're going to allocate these. Definitely something to take a look at if you are a partnership type business there. And then on the final RevProc 2021-50 regarding amended returns, another 1065 issue for partnerships, and their ability to issue amended K1s to their partners as an alternative to filing an administrative adjustment or whatnot. So, I think, the IRS has been good. The AICPA has asked for these issues to be addressed, and the IRS, took some time at the end of 21 and did that. So I think that's good for everybody. So on the next slide, just on the new income tax treatment by states, it did vary by what state you were in. Not every state followed federal and considered it non-taxable income. Fortunately for us here in New York, they followed federal treatment for PPP loans, and that is not included in your gross income for tax purposes as well. So PPP, I guess, get your forgiveness in for your second draw loans if you haven't, and watch your expenses, what you're using for forgiveness, if you may be eligible for retention credits, or you participated maybe in the Restaurant Revitalization Fund program or the SVOG. You got to watch. You can't triple or double dip on payroll costs on these programs. Chuck, talk to us a little bit about EIDL.
Yeah, thank you, Tom. So we're going to start the economic injury disaster loan discussion with the actual loan part, and then we're going to talk a little bit about the advances or the grants that they issued as well. So with respect to the loan, the program is closed as of 12/31 for any new loans. So if you haven't received a EIDL loan from the SBA, then the opportunity is essentially closed. However, if you did get an EIDL loan, you still have an opportunity to apply for additional funds if you want them under the exact same terms. So any additional funds that might be granted to you will still have a loan term of 30 years. We'll still have an interest rate of 3.75% unless you're not for profit, and then it's 2.75%. And I believe payments on any additional funds will be deferred for 24 months. I don't think that resorts back. Additional funds, I don't think go back to the original origination. I could be wrong, but either way, if you got an EIDL loan and you'd like more money, definitely apply today. In fact, in the Buffalo Business First online, there's an article on February 1st, interview with the SBA, and there's still $11.8 billion of funds available for anyone that is interested in getting an increase to their EIDL loan.
Yeah, I think that from with the SBA, what I read on that is it goes back, the deferral goes back to the date of the original loan.
Okay.
So you have 2 years from that date. It used to be 18 months. And then when they started doing the loan increases, they just made it 2 years back to the original date. So kind of keeping everybody similarly whole in that sense.
Okay, still really, really good deal. You know, even if you've gotten an idle loan, chances are pretty good that you haven't started making payments yet. Actually, chances are 100% because it's 24 months after the origination. And I don't think these started originating until April or so of 2020. But if you did get an early loan, then your payment's going to be coming due soon. So just pay attention to that. Hopefully you get notification of when you're supposed to start making payments. And that reminds me, you know, it's always a good idea to go back if you haven't looked in a while at your agreement with the SBA. There are some restrictions in those idle agreements that kind of catch some people by surprise. They didn't put liens on any property as far as I know. So even though if you received a loan that was greater than, I believe, 500,000, I think they were going to put some, they talked at least about getting security on property, but I don't think they formally put any liens on property. I could be wrong. Any loans greater than 200,000 require a guarantee from the owners or for the, well, either owners or management, depending on the type of business. And, but there are some restrictions on selling property and also paying bonuses. So you're going to want to pay attention to those. Reread your loan agreement. Make sure you're not in violation of any of the terms. You know, I've had a lot of people say, well, I'm a business. I sell property all the time, or I may, retire a vehicle or equipment and purchase a new one. I really don't think replacing equipment is a problem, even though technically if you read the agreement, it might be. You know, as long as there's enough collateral, as long as your collateral situation is either going up or staying the same, I don't see how the SBA would care. But if you're going to sell major property and you've got an outstanding loan and your collateral situation is going to decrease, you need to get permission from the SBA in order to do it. So just something to pay attention to. So, I know that these loans were not the most thrilling for people during the pandemic when free money was available through PPP and ERTC. But in retrospect, 3.75% over 30 years is still an excellent deal. So, again, if you got a loan and you'd like more money, please consider applying for additional funds. Even if you're offered them, you can still choose not to take them. You can at least see if you qualify. But I wouldn't hesitate to do that. Okay, let's talk about taxability. We do get this question often, is the idle loan taxable? The idle loan, is a loan, and so you're not actually getting anything for free. Yes, they deferred payments, but of principal and interest. And the only thing that deferral is doing is delaying the timing of when you're going to pay back the interest. When you pay the interest is when you'll be able to take the interest deduction on your tax return. So there's no exclusion on interest deduction with respect to idle. When you pay it is when you get to take the deduction. And otherwise, it's a non-event from a tax perspective. This is a loan, is repayable. You're not getting any principal given to you for free. And so any expenses paid with the loan are also not disallowed. They continue to be deductible or not deductible as they always were under the current IRS code.
Not forgivable. Everyone says, oh, it's
Not
only
forgivable.
PPP is forgivable.
But just to kind of make it more confusing for everyone, they use the exact same terminology for an advance. So on this next slide, we're going to talk about the advance portion. So very early on in the pandemic, Tom and I were recommending everyone apply for an idle loan because they're going to give you up to $10,000 for free. It's a grant, is not required to be paid back. We've seen the majority of our avid listeners all did this, and they all got a significant amount of money that was never required to be paid back. So this portion of the idle program was not a loan, it's a grant, and it's free, and you never have to pay it back. Originally, they were talking about you not getting forgiveness on your PPP loan for this amount, but they took that away as well. So it literally was just free money. And even better, it's not taxable federally, and it's not taxable in New York State. If you're in a different state other than New York, you're going to have to look up the rules. But for New York State and for federal purposes, you'll never pay tax on this free money. which is good news. Now, if you're saying, well, I didn't get this, sorry, it's too late. But if you are in a situation where you could apply for where you did apply for the EIDL targeted advance, so this was additional advance available to certain businesses that had a significant decline in gross receipts and also were located in a low income community based on mapping that the SBA does, and you had 300 or fewer employees, you could apply for this targeted EIDL advance of up to 10,000. If you did that and you were denied, you can reapply now if you think you deserve it. So that's the only thing you can do now with the advance. You have to have an application that's already been made prior to 12/31. You can reapply if you want. There's funds available, and maybe they'll take it a little easier on you this time. I already talked about this, but the advance is not taxable in New York State. So I think that's all I want to say about that. All right. My favorite topic, and I think Tom's too, is employee retention tax credits. And I want to use this portion of the webinar just to give you an update on exactly where we are with this credit and what's still available to you if you're interested, and also how this will be taxed or not taxed and kind of how that works. So I really like this slide that Tom created here. It's a nice graphical overview of exactly what happened and when with respect to employee retention tax credits. We still continue to hear so much misinformation out there, and it's not surprising because they changed the rules so many times. So depending on who's Googling what, you might get the old rules, the new rules, or something in between. So all you need is on this slide. If you've applied for your credits in 2020 and 2021, great. If you have not applied yet and you're thinking about it, we'll briefly talk about what to do. And if you don't even know what I'm talking about, please call us and we'll talk through it with you and see if you qualify. But here's the original rules. So the original rules are actually part of the CARES Act. So this was enacted on March 27th of 2020. Originally, if you were going to get a PPP loan, you couldn't take an ERTC. You couldn't do both. So most people ignored it. If you didn't qualify for PPP during that period of time, you may have qualified for ERTC, and the credit was capped at $5,000 per employee per year, based on $10,000 of wages and a 50% credit on that. It was limited to small employers who had less than 100 full-time employees. But if you had more than that, you could still get the credit for any employees that you may have paid healthcare or payroll during periods of time that they weren't performing a service. If you continued to pay them while they were laid off or asked them not to come to work because of COVID, no matter how many employees you had, you'd still be eligible. If you were not essential business and shut down, had a gross receipts decline greater than 50%, or were under partial government suspension orders. Anyway, on December 27th, 2020, they changed the rules and said everyone can get ERTC even if you took a PPP loan. So this is when Tom and I kicked it into high gear with a lot of webinars, made sure everybody knew this was out there, made sure we could, if you thought you qualified or just wanted to explore it, we looked back on the situation in 2020 and figured out if we could, if you were eligible for ERTC, and how best to work around your PPP loan in order to maximize your credits, which became, under the new guidance, $7,000 per quarter in 21. So instead of $5,000 per year like it was in 2020, it got extremely more lucrative. And so that's 70% of 10,000 per quarter, and some people qualified for multiple quarters. So this got pretty high pretty quick. It's not too late to apply. So if you think that you may qualify because you had a significant gross receipts decline, and you only need a 20% decline in 21 compared to 2019 to qualify, if that's the case, then you have up to 3 years since you filed your original 941. That's your payroll tax filing that goes to the IRS. You have up to 3 years to file. So there's plenty of time to take your time, make a proper evaluation and work with a qualified CPA to make sure you're getting the most money possible. So anyway, this particular act that was enacted on 12/27 only allowed ERTC through June 30th, 21. Then the American Rescue Plan Act of 21 came along, enacted on March 11th, 21. This allowed the credit all the way to December 31st, 21, depending on your eligibility. Great news, everybody was going to get it for all of 21. You started hearing people put out publications that said you can get up to 28,000 per employee in 21, which was true based on 7,000 per quarter. But then the Infrastructure Act came along, and they did this right in the middle of November, halfway through Q4, and said ERTC is going to end as of 9/30. So sorry about all the people that have already started taking it real time on your payroll tax returns. You're going to have to pay that back. We need the money for the infrastructure bill. So that's what they did. Only group that didn't get cut off as of 9/30 as a result of this late act were recovery startup businesses. So I've been able to help some businesses that started in 21 or later, and they qualify as recovery startup, and they're going to get the credits all the way through the end of the year. Everybody else, it stopped as of 9/30. I know people are probably thinking, okay, Congress has changed their minds so many times. Just look at all these different acts. When's the next change coming? It's probably not. So I don't think this credit just didn't get the spotlight that it probably deserved for a number of reasons, but mostly because the IRS isn't putting out much information about how much dollars they've been giving out, and they certainly haven't been totally forthright with how behind they are in processing these credits. We're going to talk a little bit about that, but the money's taking so long to get to the people that really need it that it's just, although it's lucrative, it's also extremely, extremely slow. And it's really we're having a lot of patient clients who are still waiting for stuff that was applied for back in April of 21. So that part of it is very frustrating. But regardless, as they say, better late than never. There's big dollars here. So if you're interested in exploring this more, please give Tom and I a call, and we will be able to help you out. For all the people on the phone that are on the webinar that did get the credit, and you're wondering about taxes, let me just talk about the status of processing. So let's just jump into where the IRS is right now. Right now, the IRS, or at least as of January 26th, and this is the last public communication they made on the topic, they had 1.1 million unprocessed Form 941s. 941 forms are typical quarterly payroll tax filings. Most people make them electronically. Some are still using snail mail. The snail mail ones, I think, are the ones that are delayed in processing. And in some cases, people claim their credits on the 941. You could do that if you weren't concerned about working around a PPP loan. Then it was generally the quickest way to get your money if you're filing electronically. If you're not, then it's probably taking just as long as the 941X. But the IRS is extremely behind on processing Forms 941. I don't know what their typical backlog is, but I'd have to say it's 10% or less of this number. This is mostly because of this is mostly due to COVID. The IRS is dealing with COVID just like we all are too, and plenty of agents are not coming to work. And on top of that, the whole ERTC credit was not something the IRS came up with. Washington did and said, you're going to do this, IRS. And our IRS is like, okay, thanks for the heads up. And so they're doing their best, but they're way behind the 941s. Now, 941Xs is where most people are claiming the credits because they were working around PPP loans or just weren't able to do the calculations in time to get them on the real-time 941s. These are all manual. There's no electronic options. So the IRS had 445,000 of these on January 26th to process. These are literally sitting on someone's desk in Cincinnati, most likely, and for at least New York State filers are all filing in the Cincinnati office. They're literally piled up on someone's desk, and they're pulling them off the pile in who knows what order, and processing them manually. And we all pray to God they don't make a mistake, but they are making mistakes. and that creates a whole nother headache. So, just be patient. They will get processed. If mistakes are made, there'll be an opportunity to rectify that. But it is a frustrating process, especially for those that are patiently waiting and their businesses are suffering.
Yeah, and the number's not going down. We've been tracking this on the IRS website with that link below for, about a month or so now, and that 445,000 kind of just sways a couple thousand every couple of weeks, and you got to figure there's more returns coming in, they're getting a few out, so net, they're not really getting anything done. It's unfortunate, it really is.
Yep. Okay. On the next slide, let's talk about the tax effect. So, you hear some people say that the employee retention tax credit is taxable. And that's like one of those statements that's both true and untrue at the exact same time. The money that you receive from the IRS is not taxable, so it's not included in gross income. However, the credit that you receive creates a situation where you cannot deduct, you have to subtract it from your deductible payroll. So your deductible wages, what would normally be deductible, are reduced by the amount of credit you received. And we'll show on another slide, it's actually reduced in the period that you paid the original payroll. So, we'll talk about timing of how you have to reflect this on your return. But at the end of the day, unless you're a not-for-profit who's not paying taxes, there will be a tax impact from the ERTC. So, that kind of stinks. They didn't give anyone a free pass on this one. But at the end of the day, it's still extremely well worth doing. Receiving 70 cents on the dollar or so is still worth it. All right. This was just a little example. So, another thing that's confusing folks is, the way that ERTC is applied for is that you're allowed up to 10,000 of qualified wages now in 21 every quarter, in 2020 for the full year. And some people think that it's 10,000 of wages that are reduced from deductible wages, but it's not. It's actually the 70% credit, or in 2020 the 50% credit. It's the actual credit itself that reduces the deductibility of wages. So make sure your CPA or whoever's doing your taxes don't over penalize you for ERTC. It's only the credit you receive that's the portion that ultimately is reduced from your wage deduction. I guess the other thing I wanted to point out here, and I probably should have done it earlier, but how do you get these credits? So for those of you still waiting, you might still have that question. Even though they've kind of labeled this whole thing as a payroll tax credit, and it is, it comes in the form of a check from the IRS. It doesn't reduce your payroll tax responsibility unless you're filing real time on a 941. If you do that, then first they reduce any payroll taxes you still owe to the IRS. The rest of it is paid to you in a check. So that's the other thing that makes this program so lucrative. If you never paid it's not possible, but if you never paid $1 of payroll tax, you're still going to get the full amount of the ERTC in a refund check in your mail. So again, this is really lucrative. It doesn't create some future deduction or credit you have to wait years and years for it to come to fruition.
Cashback.
It's cash back. All right. And then finally, I want to talk about timing. So this is another extremely confusing aspect of the credit, but I think the easiest way to say this is if you apply for 2020, if you're using 2020 qualified wages to apply for 2020 credits, your 2020 tax return, which has likely been filed, is going to need to be amended, and you'll need to reduce your wage deduction by the amount of credits you're expecting, not what you've received, but that you're expecting for 2020. Now, I have some people, this is not an advocated tax position, so please don't quote me, but you can take your time doing your amendment for 2020 because the IRS is not going to charge you any penalties or interest for the late payment that you're ultimately going to owe, if the only reason you're amending is for ERTC. So I have some people kind of taking their time with their amendments because they're waiting on their credits and they don't feel like they're in any hurry to do it. But technically, at the date that you file for the credit, it's almost a guarantee you're going to get the money unless the IRS makes a mistake. And that's the date you should amend your 2020 return to reduce your wage deduction, which unless you're in a certain situation like an NOL carry forward or something like that, you're probably going to owe some taxes. But I'm just saying I'm not sure you need to be in a hurry to do that if they're not going to penalize you for being a little late. But don't forget to do it. For 21, it's a lot easier. No one's filed their 21 returns yet. So if you claim 21 credits, just make sure your CPA is aware so they can reduce the wage deduction for 21. That'll take place in the normal timing for your 21 returns. Before you ask, if you're an accrual or cash basis taxpayer, none of that's going to matter. Everything I just said still applies to you. 2020 credits have to be on the 2020 return, even if you're still waiting for them. Yeah, this slide just talks about the fact that penalties for untimely payment don't apply, so no problem there, which makes sense. I mean, if you couldn't have known about ERTC when you did your 2020 return, so why would you be penalized for having to amend your 2020 return? Okay, finally, I just want to say that every state's going to be different on how they're going to deal with ERTC, but New York State treats it exactly the same as federal. So most of us are New York State filers. You don't have to worry about it. It's going to be exactly the same as federal.
Thanks, Chuck. Yeah, the retention credit has been made for an interesting 2021 for us. I think if you look at the 3 notices or 4 notices, it's over 160 pages of guidance plus like 95 FAQs. It was definitely interesting to go through that and the changing rules and whatnot. So, but very lucrative, like you said. I just want to talk about another tax credit real quick. The paid sick and family leave tax credits. These were 2 different programs based on 2 different acts of Congress. The first one came about in what we would call like the phase 2 COVID relief in 2020. It was the Families First Coronavirus Response Act, or FFCRA. And then the credits for that were available from April 1st of 2020 through the end of 2020. And then they were extended by the Consolidated Appropriations Act to March 31st of 2021. And then after that, the new administration in their American Rescue Plan Act reinvigorated these paid sick and family leave tax credits. They made them voluntary for businesses. You did not have to do this, but it was now available from April 1st to September 30th of 2021. So basically gave you 2 more quarters to use them. And generally speaking, these are for people employees who had COVID, were quarantining because of COVID, or they had to take time off because they had kids who weren't in school and they didn't have any daycare or anyone else to watch them. So the paid sick, the family leave, you were able to get a certain dollar amount of tax credit for wages paid to these employees during this time period. The nice thing about the American Rescue Plan was that it actually expanded the scope of the credit to include when, time off for vaccinations or sickness related to getting your immunization, or, waiting period for that to obtain it, or to care for an individual in your family who was recovering from any illness related to the immunization as well. So, like I said, these credits, really, this was something not a lot of people really looked at hard. If you looked at the numbers that are available from the IRS through Q2 of 2021, just on 941s that they've processed, only about $10 billion credits were paid out on this. You really had to kind of have your act together with your payroll provider and really have good documentation on how long these people were out, notes from doctors and whatnot, in order to really substantiate getting this credit. Now, from the FFCRA purpose, the government's essentially paying you the wages for these employees that were out on leave. So they're included, these tax credits are included in your gross income. But unlike the retention credit where you had to deduct the wages that you were getting credits on, you don't deduct the wages here. So for the paid sick leave credit, so there really is no effect on you. You're increasing your gross income, but you also have the deduction to cover that increase in gross income. So there's really no effect on you tax-wise for this. And it really did the same thing on the next slide for the American Rescue Plan portion of it. Yes, the credits are included in gross income, but you get the deduction for those wages as well. There were 2 sets of FAQs that the IRS published on these tax credits. I included the links on both of these slides here, just for people who are interested. When it came to reporting these, the IRS issued guidance in late 2021 for the American Rescue Plan credits on how to report them on employee W-2s. You have to report the leave wages in box 14 or issue like a separate wage and tax statement, basically explaining that these credits are related to this program and were, paid by the government. There was guidance issued last year or in 2020 as well for the FFCRA credits. Again, this was something really, really more payroll related. You really had to have a good, working effort with your payroll provider on these. And I think a lot of people took these in real time on their 941s. So, if there are questions or issues, you definitely want to talk to your CPA on this a little more and see if there's anything you could still qualify for. From the state tax treatment, there is a little bit of a difference in the state tax treatment here than federal, especially for New York. For New York, there's a subtraction adjustment from federal gross income, and for the credit amounts, that's taken on the IT-558 form. So you do have to, basically adjust your federal gross income. You're allowed a subtraction for the gross income on these credits for state tax purposes. So definitely, if you did have this, you want to talk to your CPA or tax preparer about how to handle it correctly, on your 2021 income tax returns. The next program, real quick, I'm going to talk about is the Restaurant Revitalization Fund. This came out as part of the American Rescue Plan in March of 2021. It was essentially a great idea to help some of the restaurants and bars and food service providers out there who were struggling due to the effects of COVID. Here in New York, all these businesses we would consider partially suspended by New York State pause orders and whatnot. All those restrictions were finally lifted on June 14th of past year, but still the restaurants were struggling, So Congress appropriated $28.6 billion of funds for this. The money went really quick. About 278,000 restaurants applied, and only about 100,000 actually got funding. So there's a lot of people I know spent time, working on this and trying to apply, and unfortunately, they were shut out on this. If you did get the money, you have until March of 2023 to use it. And I think a lot of people most likely spent this already in 2021 because you could go back to the start of the pandemic in February of 2020 and essentially claim expenses you paid, during that time, anything from payroll to supplies to food and beverage that you purchased, improvements that you made like for outdoor seating, repair and maintenance and whatnot. So I think a lot of people already use these funds up. The one thing that you did have to do by 12/31/21, this past end of the past year, was go to your application portal and basically report how you use the funds against all these eligible uses. So there was SBA reporting for those people out there who did get this, had to have done that by 12/31 in order to keep, on track with the SBA. Regarding the tax impact on these, on the next slide here, you can see that, part of the American Rescue Plan said these grants, these funds are not includable in taxable income. The eligible expenses that you paid using the funds are fully tax deductible. So it's just a tax-free grant. It's not a loan. You don't have to pay it back or anything. If you don't use it all by March of 23, you do have to give that money back. I just don't see that being an issue. But these, funds are tax-free for federal purposes. And then on the next slide, New York really doesn't specifically lay out how they treat this, but generally they're saying that, if a federal provision is not addressed in the New York State income tax form instructions, it means there's no separate adjustments are necessary at the state level. And there's nothing on the IP 558, the modifications from federal, that require you to make any adjustments to the Restaurant Revitalization Fund. So that's kind of where that is. Regarding this and the money that was available, there have been some reports that Congress is looking to do something else to help the restaurants now and kind of reinstitute this fund, considering so many businesses out there did not get any money as part of this. Whether or not that happens, we'll see. I've read some reports, they're talking about another 60 billion, but if the restaurants want something, then the gyms and the salons and the hotels will all probably want something too. So I don't know, Chuck. I don't see Congress really moving on this one.
I think if we see anything, Tom, it's going to be targeted, extremely targeted. So, it won't be for everyone, but, businesses, restaurants, or maybe some of those other venues that are continuing to be extremely impacted, probably measured by gross receipts declines. I think they'll probably focus on certain communities, it's just going to be very targeted if we see anything at all in 22.
Yep. Chuck, you want to take us home then on this last section here regarding the shuttered venue grants?
Yeah, I've looked through the list of participants, and I don't think anyone that's currently with us on the webinar qualified for a SVOG or a shuttered venue operator grant. We did have the pleasure of helping a couple of our favorite venues here in Western New York, and I think this was a really nice grant because those particular venues definitely needed this. So instead of going through the rules, I would just simply say that just to be an awareness that this was out there. It's no longer available. The funds have been distributed. It's helped a lot of people, and the folks that did get it are in the process of kind of reporting how they used the money. And they got a nice break from the federal government and the fact that it's not taxable, although many of these venues are not taxable anyway. And New York State's going to follow that treatment as well. And then just briefly, other programs. I don't know too many people that participated in the New York State pandemic's small business recovery grant program. But to the extent that you did, this is excluded from taxable income for both federal and New York State purposes. Otherwise, if it isn't something we've talked about today, there were various other smaller government grants available for certain situations. Those are all likely, if they're not specifically excludable, then they're taxable. So I think we've talked about everything in this deck that actually got the benefit of not being taxable.
Yeah, so just to recap for everybody, what we talked about, regarding PPP loans. If you haven't filed for 2020 forgiveness yet, definitely get on it right away because you're making payments to your bank right now on these loans. 2021 borrowers, definitely start, getting your forgiveness in if you haven't already.
Yeah, and as I mentioned before, if you did get an EIDL loan and you'd like an increase, you can get your application in for a loan increase. I would say the chances are really good for you to get an increase. So if you want one, I definitely would suggest applying for it. We're seeing great success with the increases. If you made an application for a targeted advance up to 10,000 and you got denied, you can reapply. They may consider it a little bit more favorably this time around. But the EIDL loan, I think as we get, into 22 here and we realize that there's not much more government assistance coming, a 3.75% loan for 30 years without any real liens being put on property is pretty good. So definitely not something to ignore, but if you didn't apply before, didn't get a loan before, unfortunately, that particular program is not going to be available anymore. For ERTC, a lot of confusion that the government or Congress eliminated it. So if you haven't applied yet, you're in trouble. Not true. It's only gone for Q4 unless you're a recovery startup business. You have 3 years after you filed your original 941s to claim it, or to file a 941X and claim the credits. So there's no rush, but if you haven't done this and you think you might qualify, hold off on PPP forgiveness. It's the only reason I'd suggest holding off if you haven't done it already. Credits first, PPP forgiveness second. Why? Because in some cases, we may suggest that you apply for forgiveness using something other than payroll, which frees up some payroll to use towards credits. Overall, you're in a much better position. Otherwise, Tom's exactly right. There's no point in waiting on forgiveness. You might as well get it done and behind you while the banks are being extremely responsive and attentive. After a while, they're going to move their resources to other things and might take a little longer to get your application approved through your lender and then ultimately the SBA.
Yeah, and then regarding the paid sick and family leave credits, they all expired at the end of September of 2021. There's some reporting that goes along with that on your W-2s if you took advantage of that. Still maybe some opportunity to go back if you have good documentation and claim some of those credits. Regarding the Restaurant Revitalization Fund grantees, should have done your reporting by 12/31 on the SBA portal. If you are in the restaurant business, maybe there's some more money coming from Congress. We'll see. And if there is, we'll let you know about that.
Tom, question from the audience. Maybe it's a good time to just clarify it. But ERTC, we talked about, that it's sort of roundabout taxable through the reduction of your wage, your typical wage deduction. New York State is married with the federal government on this, right? That they're exactly the same?
Yes.
Okay. So yeah, so in case anybody missed that, New York State and federal treated it exactly the same way, which isn't exactly good news. We would have preferred New York State say you still get your typical wage deduction, but that's not the case. They're the same.
Yeah, there's no adjustments for it on the IT 558 that I can see.
If you have any other questions, please type them in the chat. We'll get those answered right away.
Yeah, this last slide is kind of a general summary of the COVID relief programs that we discussed this afternoon and the federal tax treatment. You can see generally everything is non-taxable, so that's good for everyone out there.
And our contact information is here. I think looking through the list of participants, I think we've worked with the majority of folks, and certainly appreciate your attendance today. If there's anything that you heard that you'd like a little more clarification on, please reach out to us. We'll get back to you right away. I think there's still plenty of businesses finding out about ERTC. Maybe they weren't aware of it before. Or maybe people are starting to get their checks and now they're telling others, and all of a sudden, it's gaining popularity. So I know Tom and I are staying extremely busy doing this, but we're always willing to help out our clients with anything we can. And also, we will keep everyone apprised of anything further that may come through Congress, any additional opportunities for for funds and assistance, because I know there's still plenty of businesses struggling.
Thank you, guys. We'll hang on just another minute if anybody has any final questions or needs something repeated or clarified. But want to thank everybody for joining us today. Feel free to reach out to us even after the webinar if you have questions or if you pass this along to somebody else.